Here is the move that explains the whole week, and almost nobody is naming it. Wall Street just turned Bitcoin into a yield product. On the 16th, BlackRock, the largest asset manager on Earth, listed an exchange-traded fund that sells covered calls on Bitcoin and pays the option premium back to you as income, targeting a yield in the high teens. Goldman Sachs has a more aggressive version coming in early July. This is not adoption news. This is an absorption. Because the thing those funds package, Bitcoin's volatility, was the entire substance of the speculative premium. And once you can buy Bitcoin plus yield in a regulated wrapper, the levered proxy that sold you that premium loses its reason to exist. Look at STRC. Its enterprise value has fallen below the Bitcoin it holds. Its flagship preferred trades a quarter under the price it was built to hold. And a major research shop is publicly telling it to sell $3 billion of Bitcoin. The moat is being arbitraged away in real time. So where's the edge? You own the party collecting the toll on the absorption and the asset itself, not the proxy whose whole model was the vanishing premium. The same thing is happening to oil, which fell through a strike on Iran, and to gold, which just lost $4,000. The market is converting its scarcity premium assets into income streams and surpluses. The crowd is trading the crash. The evidence reads the absorption. This is the asymmetric. This is the asymmetric, issue 30, the domestication, tech and crypto investing for thoughtful retail from an operator's lens. Last issue named the force doing the re-rating, a draining liquidity tide and a rising dollar, exposing the most levered asset first. This issue names what the tide leaves behind. While the lever breaks, Wall Street is quietly doing something more permanent to Bitcoin. It is domesticating it. The crypto crash has a second act, and it isn't a crash. It's an absorption. Here's the one-line read. Wall Street is turning Bitcoin into an income product. On the 16th, BlackRock launched the iShares Bitcoin Premium Income Fund, ticker BITA, on the Nasdaq, a covered call fund targeting a 15 to 25% distribution yield while keeping about 70% of Bitcoin's upside, at a fee of 0.65% that undercuts the incumbents. Goldman Sachs has a more aggressive version, with a 40 to 100% call overwrite expected in early July. Selling Bitcoin's volatility as packaged yield is the structural killer of the crypto-treasury premium, and that premium is gone. STRC's enterprise value has fallen below the Bitcoin it holds. Its flagship preferred hit a record low near $82, about 25% below par. Issuance is paused. And Grayscale's research head urged it to sell more than $3 billion of Bitcoin. The same depremiuming hit commodities. The United States struck Iran on the 26th, and a tanker was hit in the Strait of Hormuz. Yet crude fell about 4% to roughly $69, the lowest since February. Gold broke below $4,000 for the first time since November. The market is converting its scarcity premium assets into income streams and surpluses. You'll see the same labels throughout. Confidence, high, medium, or low. Consensus versus variant, what the market believes and where we may differ. And on every call, what would change our mind. That's the discipline. Part 1, the macro regime, the absorption of the premium. The 30-second frame. 1. Bitcoin is being domesticated. BlackRock's income fund and Goldman's forthcoming product turn Bitcoin's volatility into a packaged income stream, the successor to the spot exchange-traded fund wave, and the killer of the crypto-treasury premium. 2. The lever it kills is already broken. STRC's enterprise value is below 1 times its own Bitcoin. Its preferred is about 25% below par with issuance paused. And Grayscale is openly calling for a $3 billion Bitcoin sale. 3. The same absorption hit commodities. The United States struck Iran and a tanker was hit, yet crude fell to about $69 on recovering Gulf supply. The live base case is crude toward $40 on superabundance. 4. Gold lost its $4,000 floor for the first time since November on a firmer dollar. And 5. Equities rotated. They didn't break. The S&P and the Dow held near flat, while the Nasdaq logged a 5th straight down day on chip narrowing. Start with the engine. Wall Street is packaging Bitcoin's volatility into yield. The iShares Bitcoin Premium Income Fund listed on the Nasdaq on the 16th. It holds spot Bitcoin, shares of BlackRock's spot Bitcoin fund, and cash, and sells covered calls on roughly a quarter to a third of its assets each month, paying the premium out as income while keeping about 70% of Bitcoin's upside at a fee of 0.65%. Here's why the mechanism matters more than the marketing. A covered call is mechanically a short volatility bet. It earns by selling away upside. And Bitcoin's volatility was the entire substance of the speculative premium retail paid up for through levered proxies. Package that volatility into a regulated, fee-bearing product, and you commoditize the exposure. The same move the spot fund made on the old Grayscale trust. It collapses the premium. Goldman's more aggressive version is expected in early July. This is a market structure shift, not a price event. Now the lever it kills. Strategy's enterprise value has fallen below 1 times the Bitcoin it holds for the first time, roughly 0.6, meaning its equity, preferred, and debt together value the company below its own Bitcoin. Its flagship preferred, ticker STRC, hit a record low near $82, about 25% below the $100 par it was built to hold, forcing the company to pause preferred issuance and lean on dilutive common stock sales. Last issue framed this as a financing event. The domestication adds a structural layer. Even if liquidity returns, the premium that powered the flywheel, paying multiples of net asset value for levered, convenient Bitcoin exposure, now has a permanent competitor in a BlackRock or Goldman income wrapper. The convenience and yield moat is being arbitraged away. Grayscale's research head publicly urged Strategy to sell more than $3 billion of Bitcoin to cover about 2 years of obligations and restore confidence, while expecting a higher dividend rate on the preferred. The 30th, with its ex-dividend date and rate reset, is the next pressure point. The same absorption ran through commodities, and this is the cleanest signal of all. The United States struck Iran on the 26th, and a tanker was hit in the Strait of Hormuz, yet crude fell about 4% to roughly $69, its lowest since February. The driver was supply, not demand fear. Gulf transit volumes recovered towards 75% of pre-war levels. Saudi Arabia began loading at its main terminal, and the United Arab Emirates, Kuwait, and Qatar boosted output. One prominent strategist's base case is crude toward $40 on a Western Hemisphere superabundance. A barrel that falls through a strike on Iran is pricing abundant supply, not a geopolitical premium, the commodity analog of Bitcoin's volatility being absorbed. Meanwhile, gold broke below $4,000 for the first time since November, pressured by a firmer dollar, the haven premium compressing too. And equities rotated rather than broke. The S&P and the Dow held near flat, while the Nasdaq logged a 5th straight down day. An orderly depremiuming, not a panic. Part 2, In Focus, the toll collector on the domestication. The In Focus name is BlackRock, ticker BLK, the company on the winning side of the absorption. Here is the scale, $13.9 trillion of assets under management at the end of March. BlackRock earns a recurring fee on those assets regardless of which way Bitcoin goes, and it now sells both legs of the Bitcoin trade, the spot exposure through its flagship fund and the income overlay on top of it. Its most recent quarter, from the filings, shows about $6.7 billion of revenue, up 27% year-over-year, $2.2 billion in net income, and $130 billion of net inflows, including a record $132 billion into its exchange-traded funds. It monetizes the absorption itself, not the coin's price. Now the mechanism, the toll collector earns on the rotation, not the coin, stage by stage. Stage 1, the proxy premium breaks. Strategy's enterprise value falls below its Bitcoin and the preferred trades below par. The levered, convenient exposure loses its premium, and capital that wanted Bitcoin plus yield needs a new home. Stage 2, the wrapper absorbs the demand. BlackRock offers the spot exposure and the covered call income on top, capturing the rotation as recurring, direction-agnostic fees, the same capture the spot fund made on the old Grayscale trust. Stage 3, the fee base compounds. On nearly $14 trillion of assets and record inflows, the revenue is base and performance fees, not dependent on a financing window. The absorber earns whether Bitcoin rises or falls, the inverse of the proxy. The asymmetry. Strategy's model needs the premium and the financing window. BlackRock's model is the absorption of that premium into fees. The debate, the bull, this is a toll collector, recurring fees on nearly $14 trillion of assets, earned regardless of direction. It sells both legs of the Bitcoin trade, so every dollar rotating out of a broken proxy and into a fee-bearing wrapper is BlackRock's to capture. The Domestication is a tailwind, and record inflows plus its private markets acquisitions widen the moat. The bear. And it's real, a fee business is still BITA to markets. A sustained drawdown shrinks assets and the fees that ride on them. Core passive products face permanent fee compression. There's acquisition integration and concentration risk. And a covered call product that disappoints in a sharp Bitcoin rally because it caps upside could see outflows. The referee is quarterly net flows and how fast the new income fund gathers assets. The read, a research view, not a call. BlackRock is the structural counterpart to last issue's strategy. The filings make the contrast concrete, nearly $14 trillion of assets, about $6.7 billion in quarterly revenue, $2.2 billion in net income, $130 billion of net inflows, a fee machine that earns on the exposure, and the income wrapper whether Bitcoin rises or falls. Strategy's model needs the premium and the financing window. BlackRock's model is the absorption of that premium into fees. The asymmetric point is not buy BlackRock or sell BlackRock. It is the spread, own the toll collector on the absorption and the asset itself, and avoid the proxy whose entire model was the vanishing premium. What would change the read? Sustained net outflows and shrinking assets, the bear versus continued record inflows and rapid income fund gathering, the bull. The countercurrent, the proxy derates, the asset holds, the absorber compounds. Bitcoin trades near $60,000, with on-chain metrics in a historical accumulation zone, a market value to realized value ratio near or below fair value, and more than half of supply underwater. The asset drew down far less than the proxy, whose enterprise value sits below its own Bitcoin. Read it correctly. The premium is being absorbed, not the asset. An income wrapper commoditizes the exposure and ends the proxy's premium era. It is not a verdict on Bitcoin's long-run case, which the accumulation zone signals leave intact. The stress concentrates in the lever, not in spot, and the corner that compounds is the absorber. The asset gatherer's fees and the cash-generative rails keep compounding through the repricing. Own the absorber and the asset, not the reflexive proxy. And the thematic, own the toll collector on the absorption. Once a speculative exposure can be bought as a regulated, fee-bearing income product, the premium the levered proxies extracted does not come back. It accrues in fees to the absorber. So own the toll collector, the asset gatherer monetizing the crypto income wave from both sides. Own the self-funding cash machine, the hyperscaler that funds the biggest build on Earth from operating cash flow. And the proprietary data compounder whose margin doesn't reset with a cycle. Own the scarce input and the rails, the sold-out memory with pricing power, the scarce baseload power, and the cash-generative tokenization rails. And be wary of the melting premiums, the reflexive crypto-treasury lever, the geopolitical premium in oil, the haven premium in gold, and the exit liquidity-dependent private artificial intelligence complex. The discipline is not sell crypto or sell commodities. It is to own the toll on the absorption and avoid the proxy whose moat the absorption removes. Part 3, the domestication, own the toll collector, not the lever. What we are watching over the next 10 days. Goldman's Bitcoin Income Fund launch in early July, the second leg of the domestication wave. The income fund asset trajectory, whether flows really rotate from proxies into wrappers, the core thesis. Strategy's June 30th ex-dividend date and rate reset, any forced seller signal is the contagion trigger. The preferred versus par and the enterprise value versus 1 times Bitcoin, reclaim it, and the premium can restart. A deeper discount and the proxy model stays shut. Bitcoin versus 60,000, a hold on a softer dollar is the bottoming tell. The dollar index, back below 100 partly restores the proxies, above 104 deepens the divide. Oil and the Strait of Hormuz, the abundance versus war tell. Gold near 4,000, the next inflation print, and BlackRock's quarterly net flows, the toll collector tell. And we keep score in public. BlackRock enters as the toll collector on the domestication, nearly $14 trillion of assets, earning on both legs of the Bitcoin trade, watch net flows. The domestication theme income wrappers kill the proxy premium. Strategy updated, the premium is structurally challenged, not just liquidity stressed. Commodities, the barrel reads abundance, not war, and gold's haven premium is compressing. And carried forward, Apple. The squeezed transmission belt, Micron, the sold-out input, Zeta Global, the durable margin compounder, Alphabet, the self-funding compounder, Constellation Energy, the power bottleneck, and gold, cited by level and driver. Dated, falsifiable calls, and we grade them. So where does it land? The second act of the crypto crash is not a deeper crash. It is an absorption, and it is permanent. Wall Street is doing to Bitcoin what it did to gold and the old Grayscale trust, packaging the exposure into fee-bearing products and with covered call income funds, selling the volatility that was the entire substance of the speculative premium. BlackRock's income fund and Goldman's forthcoming product stripped the moat from the levered proxies. Strategy is the proof. Its enterprise value now sits below its own Bitcoin, its preferred trades a quarter under par with issuance shut, and a major research shop is publicly telling it to sell billions of coins. The discipline is to own the party collecting the toll on the absorption, the nearly $14 trillion fee machine that earns whether Bitcoin rises or falls, and the asset itself, while avoiding the proxy whose model was the vanishing premium. The crowd is trading the crash. The evidence reads the absorption, and the absorption pays the domesticator, not the lever. This is research, not personalized advice. Verify it yourself. We'll see you in the next issue.